Beat inflation. QYLD versus bonds, dividend stocks for income. Hi, ETF enthusiasts. Chat ETF is back, and today we're diving deep into a high-octane income machine, the Nasdaq 100 Covered Call ETF, or QYLD. This bad boy boasts a mouth-watering dividend yield that crushes boring old bonds and CDS. But wait, there's more. It also offers some downside protection in a shaky market. Sounds too good to be true, right? We're gonna crack open QYLD's hood, expose its strategy, risks, and rewards. Can it really fuel your retirement, or is it just a recipe for disaster? Buckle up, income seekers, because this is gonna be a wild ride. Hit that subscribe button and smash the notification bell, so you don't miss a second of this QYLD breakdown. Let's get chatting. Question 1. Why does Nasdaq 100 Covered Call ETF utilize a covered call strategy, as opposed to other options strategies? The Nasdaq 100 Covered Call ETF, QYLD, utilizes a covered call strategy for several reasons, compared to other options strategies. 1. Income generation. This is the primary reason. By selling call options, covered by the underlying stocks, QYLD generates regular premium income, which is then distributed to investors. This can be attractive to income-seeking investors, especially retirees, or those looking for a steady cash flow. 2. Downside protection. While a covered call limits potential upside gains if the stock price rises significantly above the strike price, it also offers some protection against downside risk. If the stock price falls, the investor keeps the premium and still owns the shares, potentially mitigating losses. 3. Simplicity and diversification. Implementing a covered call strategy manually involves selecting stocks, strike prices, and expiry dates, which can be complex and time-consuming. QYLD automates this process, providing diversified exposure to the Nasdaq 100 index while managing the covered call strategy. 4. Alignment with the underlying index. The covered call strategy generally aligns well with the overall objective of tracking the Nasdaq 100 index, as the ETF still holds the underlying stocks. This can be appealing to investors seeking exposure to the index without deviating significantly in strategy. However, it's important to consider the downsides of a covered call strategy before investing in QYLD. 1. Limited upside potential. If the stock price rises significantly above the strike price, investors miss out on those gains, potentially underperforming the underlying index. 2. Higher volatility. QYLD can experience higher volatility than the underlying index due to the options component. This can be both a risk and an opportunity, depending on your investment goals and risk tolerance. 3. Fees and expenses. Implementing a covered call strategy adds complexity, leading to higher fees compared to passively tracking the index. 4. Not suitable for all investors. Due to the income focus and potential limitations, QYLD might not be suitable for all investors, especially those seeking high growth or capital appreciation. Question 2. Why are the specific criteria used for call option selection, and why are these criteria considered optimal for achieving Nasdaq 100 Covered Call ETF's objectives? Unfortunately, the specific criteria used for call option selection in the Nasdaq 100 Covered Call ETF, QYLD, are not publicly disclosed by the fund manager. This is likely due to proprietary information, and potentially to avoid giving away valuable information to competitors. However, based on available information and industry practices, we can make some educated guesses about the criteria used and why they might be considered optimal for QYLD's objectives. Strike price year. 1. Out of the money, OTM, strikes. QYLD primarily uses OTM strikes, meaning the strike price is higher than the current stock price. This maximizes the premium income generated while minimizing the chance of early assignment, where the option buyer exercises their right to buy the shares. However, it also limits potential upside gains if the stock price significantly exceeds the strike price. 2. Strike selection might vary based on volatility and index outlook. The specific OTM strike chosen could be based on factors like implied volatility. Higher volatility might lead to higher strikes, and the fund manager's outlook on the Nasdaq 100 index. The more bullish outlook might lead to slightly closer strikes. Expiry date. 1. Short-term expirations. Typically monthly. QYLD uses short-term expirations, often monthly, to maximize the number of premiums collected throughout the year. This aligns with the objective of generating regular income. 2. Rolling options. As options near expiry, QYLD likely rolls them over to new options with similar characteristics. This ensures continuous premium income and exposure to the covered call strategy. Other potential criteria. 1. Liquidity. The fund might prioritize options with higher liquidity to ensure efficient buying and selling. 2. Volatility skew. If the implied volatility is skewed towards one side, e.g., higher calls versus puts, the fund might adjust strike selection accordingly. Optimal for QYLD's objectives. These criteria are considered optimal for QYLD's objectives for several reasons. 1. Maximizing premium income. OTM strikes and short expirations generally maximize the premium collected while minimizing the chance of early assignment. 2. Regular income generation. Short expirations and continuous rolling ensure a steady stream of income for distribution. 3. Reduced downside risk. OTM strikes provide some protection against significant price declines. 4. Alignment with index tracking. Holding the underlying stocks and using short-term options generally maintain exposure to the Nasdaq 100 index. Question 3. Why should investors consider Nasdaq 100 covered call ETF as part of their portfolio allocation strategy? Here are some potential reasons why it might be a good fit for some investors, but also some key drawbacks to consider. Reasons to consider QYLD. 1. High income generation. QYLD generates significantly higher income than passively tracking the Nasdaq 100 index due to the covered call strategy. This can be attractive to income-seeking investors, especially retirees, or those seeking a steady cash flow. 2. Downside protection. While it limits potential upside, the covered call strategy offers some protection against significant price declines in the Nasdaq 100 index. This can be appealing to investors seeking a more conservative approach. 3. Diversification. QYLD provides exposure to the Nasdaq 100 index, offering diversification within your portfolio. 4. Simplicity and automation. QYLD automates the covered call strategy, eliminating the need for individual stock selection and option management. Drawbacks to consider. 1. Limited upside potential. By selling covered calls, you cap your potential gains if the stock price significantly rises above the strike price. This can underperform the underlying index in bull markets. 2. Higher volatility. QYLD can experience higher volatility than the underlying index due to the options component. This can be both a risk and an opportunity depending on your risk tolerance. 3. Fees and expenses. Implementing a covered call strategy adds complexity, leading to higher fees compared to passively tracking the index. 4. Not suitable for all investors. Due to the income focus and potential limitations, QYLD might not be suitable for all investors, especially those seeking high growth or capital appreciation. Question 4. Why is the Nasdaq 100 chosen as the underlying index for Nasdaq 100 covered call ETF, and why is it considered suitable for this covered call strategy? There are several reasons why the Nasdaq 100 is chosen as the underlying index for the Nasdaq 100 covered call ETF, QYLD, and why it's considered suitable for the covered call strategy. Suitability for covered calls. 1. High liquidity. The Nasdaq 100 is a highly liquid index, meaning there are many buyers and sellers for the underlying stocks. This is crucial for efficiently buying and selling the covered calls, maximizing premium income and minimizing transaction costs. 2. Volatility. The Nasdaq 100 generally exhibits moderate volatility compared to other indices. This makes it suitable for covered calls, as options premiums are higher with moderate volatility compared to very low or very high volatility. 3. Growth potential. The Nasdaq 100 typically represents growth-oriented companies in technology, healthcare, and other high-growth sectors. This can be attractive for covered call strategies, as moderate growth allows for premium generation, while still offering some potential for capital appreciation. 4. Diversification. The Nasdaq 100 provides exposure to 100 large, non-financial companies, offering diversification within the technology and growth sectors. This reduces risk compared to holding individual stocks. Alignment with QYLD's objectives. 1. Income generation. The covered call strategy relies on generating premium income. The Nasdaq 100's moderate volatility and growth potential create a good balance between premium generation and potential capital appreciation, aligning with QYLD's income focus. 2. Moderate downside protection. The Nasdaq 100's growth potential offers some protection against significant price declines compared to solely focusing on high dividend stocks. This aligns with QYLD's objective of providing some downside protection while prioritizing income generation. 3. Investor familiarity. The Nasdaq 100 is a well-known and widely followed index, making it familiar to many investors and potentially more appealing than a lesser-known index. However, it's important to note here. 1. Not all Nasdaq 100 companies are suitable for covered calls. Each company within the index has its own volatility and risk profile. The fund manager likely selects specific stocks within the index based on their suitability for the covered call strategy. 2. Alternative indices might be suitable. Other indices with similar characteristics, moderate volatility, growth potential, and liquidity, could also be suitable for covered call strategies. Overall, the Nasdaq 100's characteristics and alignment with QYLD's objectives make it a well-suited underlying index for the covered call strategy. However, it's crucial to remember that the fund manager likely uses specific selection criteria within the index to ensure optimal results for the strategy. Question 5. Why does the issuer believe that Nasdaq 100 covered call ETF's covered call strategy is suitable for income-seeking investors? The issuer of the Nasdaq 100 covered call ETF, QYLD, believes its covered call strategy is suitable for income-seeking investors for several reasons. 1. High and consistent income generation. QYLD generates significantly higher income than passively tracking the Nasdaq 100 index due to the covered call strategy. This strategy involves selling call options on the underlying stocks, which generates regular premium income, even if the stock price stays flat or declines slightly. 2. Moderate downside protection. While the covered call strategy limits potential upside gains, it also offers some protection against significant price declines in the Nasdaq 100 index. This is because the investor keeps the premium received even if the stock price falls, mitigating potential losses. 3. Diversification within the growth sector. QYLD provides exposure to the Nasdaq 100, a well-known index of 100 large, non-financial companies in technology, healthcare, and other growth sectors. This diversification helps reduce risk compared to holding individual stocks. 4. Simplicity and automation. QYLD automates the covered call strategy, eliminating the need for individual stock selection and option management, which can be complex and time-consuming for investors. This makes it a relatively easy way to access the income generation potential of covered calls. 5. Alignment with investor preferences. The issuer likely believes that many income-seeking investors prioritize steady and consistent income over maximizing capital appreciation. QYLD's focus on premium generation aligns with this preference. However, it's important to consider the drawbacks before investing in. 1. Limited upside potential. By selling covered calls, QYLD caps its potential gains if the stock price significantly rises above the strike price. This can underperform the underlying index in bull markets. 2. Higher volatility. QYLD can experience higher volatility than the underlying index due to the options component. This can be both a risk and an opportunity depending on your risk tolerance. 3. Fees and expenses. Implementing a covered call strategy adds complexity, leading to higher fees compared to passively tracking the index. 4. Not suitable for all investors. Due to the income focus and potential limitations, QYLD might not be suitable for all investors, especially those seeking high growth or capital appreciation. Question 6. Why does Nasdaq 100 covered call ETF target a high dividend yield compared to other ETFs, and why is this considered an attractive feature for professional investors? QYLD does not actually distribute dividends in the traditional sense. Instead, it distributes monthly income generated from its covered call strategy. This monthly income is expressed as a dividend yield, which can be deceptively high compared to other ETFs. Here's why. 1. Covered call strategy. 1. QYLD sells call options on its underlying holdings in the Nasdaq 100. These options give buyers the right to purchase the shares at a specific price, by a certain date. 2. In exchange for selling these options, QYLD receives premium income, which is paid upfront and distributed monthly to investors. 3. This income stream is independent of the underlying stock price movements, unlike traditional dividends paid by companies. 2. High yield calculation. 1. QYLD's dividend yield is calculated by dividing the annualized distribution by the current share price. 2. Since the income is generated primarily from selling options, it can be significantly higher than traditional dividend yields from companies. 3. This is because option premiums can be substantial, especially for volatile or growth-oriented stocks like those in the Nasdaq 100. Appeal for professional investors. 1. High income potential. The high dividend yield is attractive to professional investors seeking consistent income streams. This can be used for various purposes, such as supplementing retirement income or generating returns for specific investment strategies. 2. Portfolio diversification. QYLD offers exposure to the Nasdaq 100 while providing an income stream different from traditional stock dividends. This can help diversify portfolios and potentially reduce overall risk. 3. Hedging strategies. Professional investors may use QYLD to hedge other holdings or generate income while expecting sideways or slightly declining markets. Important considerations. 1. Limited upside. QYLD caps its potential gains by selling covered calls. While it protects against downside risk, it can underperform the underlying index in strong bull markets. 2. Higher volatility. QYLD's income stream and share price can be more volatile than traditional ETFs due to the options component. 3. Fees and expenses. The covered call strategy involves higher fees compared to passively tracking ETFs. 4. Not for everyone. QYLD's income focus and limited upside potential make it unsuitable for investors seeking capital appreciation or growth. Question 7. Why should investors be comfortable with the level of risk associated with Nasdaq 100 covered call ETF strategy? Whether investors should be comfortable with the level of risk associated with QYLD's strategy depends on their individual financial goals and risk tolerance. There are both benefits and drawbacks to consider. Benefits. 1. Income generation. QYLD generates significantly higher income than passively tracking the Nasdaq 100 due to the covered call strategy. This can be attractive to income-seeking investors, especially retirees, or those seeking a steady cash flow. 2. Downside protection. While it limits potential upside, the covered call strategy offers some protection against significant price declines in the Nasdaq 100 index. This can be appealing to investors seeking a more conservative approach. 3. Diversification. QYLD provides exposure to the Nasdaq 100, offering diversification within your portfolio. Drawbacks. 1. Limited upside potential. By selling covered calls, you miss out on potential gains if the stock price significantly rises above the strike price. This can underperform the underlying index in bull markets. 2. Higher volatility. QYLD can experience higher volatility than the underlying index due to the options component. This can be stressful for risk-averse investors. 3. Fees and expenses. Implementing a covered call strategy adds complexity, leading to higher fees compared to passively tracking the index. 4. Risk of early assignment. If the stock price rises significantly, the option buyer might exercise their right to purchase the shares, forcing you to sell at the strike price, potentially missing out on further gains. Question 8. Why might Nasdaq 100 covered call ETF be preferable over other income-generating investments, such as dividend stocks or bonds? Deciding whether the Nasdaq 100 covered call ETF, QYLD, is preferable to other income-generating options, like dividend stocks or bonds, depends entirely on your individual circumstances and investment goals. Here's a breakdown of the pros and cons to help you decide. Pros of QYLD. 1. Higher potential income. QYLD often boasts a much higher yield than traditional dividend stocks or bonds, making it attractive for income-seeking investors, especially retirees, or those needing a steady cash flow. 2. Downside protection. The covered call strategy offers some protection against stock price declines compared to solely holding dividend stocks. 3. Diversification. Gaining exposure to the Nasdaq 100, a high-growth index, offers diversification beyond just dividend-paying companies. 4. Automation. The ETF automatically implements the covered call strategy, eliminating the need for individual stock selection and option management. Cons of QYLD. 1. Limited upside potential. By selling covered calls, you cap your gains if the stock price significantly rises, potentially underperforming in bull markets. 2. Higher volatility. QYLD can experience higher volatility than dividend stocks or bonds due to the options component. 3. Fees and expenses. Implementing a covered call strategy adds complexity, leading to higher fees than passively holding dividend stocks or bonds. 4. Risk of early assignment. If the stock price rises sharply, the option buyer might exercise their right to buy the shares, forcing you to sell at the strike price, potentially missing further gains. Comparing QYLD to alternatives. Dividend stocks. 1. Pros. Lower volatility, potential for capital appreciation alongside dividends. 2. Cons. Lower overall yield, more research and selection needed. Bonds. 1. Pros. Lower volatility, predictable income stream, potential for capital appreciation. 2. Cons. Lower overall yield, interest rate risk, exposure to specific issuers. Ultimately, the best choice depends on your needs. 1. If income is your primary goal, and you can tolerate higher volatility, QYLD could be an option. 2. If you prioritize capital appreciation alongside income and lower volatility, dividend stocks or bonds might be better.